This is the Value Investor Podcast with Tracey Ryniec. All things value, all the time.
Welcome back, value investors. So with the sell-off going on in the stock market right now, I wanted to see if there was any new type of value stocks out there, because we have seen quite a pullback, a correction in a lot of different industries, and even a bear markets in some industries. So as value investors, we have to start poking through the rubble, so to speak, to see if there's any true deals there. So this week, I wanted to use the PEG ratio. We haven't screened with it for a while. And the reason I like the PEG ratio when we have these kind of big sell-offs is because we are getting, reflections of the price, plus the company has to have some kind of earnings growth. And that's still key, because when you get these big sell-offs in the market, everyone tends to throw out the baby with the bathwater. And that includes some stocks that, shouldn't be thrown out. And that's what we're trying to find as value investors, the ones where the street is just, discarding it. And when you have, the total market sell-offs, that's when everything is discarded. So the PEG helps us find those companies that still have the growth. And then if you combine it with the Zacks Rank, the high Zacks Rank of number ones, which are the strong buys, and number twos, which are the buys, hopefully that means the analysts are also raising those earnings estimates. And now that we're getting mostly towards the end of earnings season now, we have some retailers, a few other tech stocks still to go, but we're mostly done now. These Zacks ranks right now should reflect whatever went on in those earnings reports, that some companies are still, beating and raising guidance, and the analysts are having to adjust those earnings estimates. So I screened with the PEG with the Zacks rank of number one or number two. And this screen on Zacks.com also comes with current average broker recommendations. We don't see that very often in the value screens. And I don't actually use the current average broker rec that often in my own screens. But what that means is that that broker is actually recommending it, not the Zacks rank, but it uses a similar 1 to 5 ranking, with a 1 being a strong buy from that broker and a 5 being a strong sell. So this is looking at what the actual individual brokers are saying about the company, and not the Zacks rank, which is just looking at the changes in the earnings estimates. So this looked for 2 or under. So we want to get, the highest broker recommendation too. We want to get them giving it a strong buy. So that's it. It didn't even look at market cap, nothing like that in this screen. And that's why I like it. It's just right to the point. Obviously includes PEG ratio, which, remember, is price over the earnings growth. And it does look for the value PEG ratio under 1. So when you get a PEG ratio under 1, it means there is both value there plus growth. And that is the key to it all. Okay, so I ran this screen and I got 21 stocks. That's a pretty good number. What was in this screen? Airlines. There were 3 airlines in it. Healthcare stocks, financials, some energy, including utilities, were in here. Pretty much what I would have thought. We didn't get technology because it's still not going to be cheap enough. And maybe some of the tech companies don't even have the right rank right now. And we didn't get no home builders. So that's a first, right? We're not getting home builders. I have a feeling just by looking at the ones I've been looking at on the home builder side, The Zacks Rank is just not there right now. Those estimates are being cut. I don't think there's a single home builder that's number one or number two. They're all threes, fours, and fives. And very few are even a three. So no home builders, nothing in that area. Actually, no real consumer names other than the airlines were in here. So I picked out three to take a closer look at. And I did start with the airlines. So let's start with that. The three airlines that made the screen were Alaska, which we've talked about in the past on other podcasts. I like it a lot, especially after it just acquired Hawaiian Airlines. It's going to give them a lot more planes, gives them the Hawaii routes, but it's also going to allow them to expand over to Asia from Hawaii operations. And those are big routes. So I'm liking all of that. But I didn't pick it for this podcast because we have talked about it recently because I do like it. Second one was American. I like American as well. They have a big hub here in Chicago, so I've flown them many times. I love their hub in Miami and their dominance of the Caribbean along with Latin America. So those areas are all doing well. Plus, they also have Europe, and that is booming right now. But the one I did pick, United Airlines, ticker UAL, because we haven't talked about it in a while. And they're also here in Chicago, big hub here. Other hubs in San Francisco, Denver, Newark. I know this because, and Houston. Can't leave them out. I know because I am a frequent flyer on United. So I thought I'd take a closer look at the one I actually fly. Now, the airline stocks have been soaring, all of them, because the demand has been so strong, especially internationally, and they can charge more on the international flights. Any of us who've been trying to book to go internationally, especially over to Europe, we know how much they're charging, right? Will there be demand destruction if the consumer just starts to say no to paying those prices? So far, they haven't said no, but will they if the overall U.S. economy starts to slow down? We don't know, but the stocks are acting like, that could be the case. In the last month, United Airlines is down 17%. So definitely in the correction category, almost a bear market. And I do think during this sell-off, just looking at the chart right now, it did get over 20%. So it wasn't a bear. It is getting a little bit of a bounce there. So now it's down only 17% in the last month. But this creates a buying opportunity, right? In these shares because it's gotten cheaper. So just looking at United, it's a Zacks number one. So it does have the strong buy coming off that earnings report. It's an A for value on the style scores, a C for growth, a C for momentum, but an overall score of A. Why does it have that A for value? Well, the PEG ratio is just 0.5. That's what we're concerned about, and that's why it made the screen. But the forward PE is just 6.7 right here. So that's really cheap, but earnings for 2025 expected to be up 22%, and then another 12% for 2026. But that's a long ways off, and a lot can happen, right? So nice double-digit earnings growth, plus the stock now coming off those 5-year highs is giving us these lower valuations. So I'm liking all of that. And then what is happening? I'm just going to take a look at the detailed estimates real quick. The estimate revisions are mostly higher in the last 60 days because United did report a while ago, but there is one that is lower in the last week. Not sure what that's about, but somebody is adjusting a little bit here. But we had 9 higher in the last 60 days for this year and 8 higher for next year for United Airlines. So this is what is going on in the airlines. We're looking for $12.96 this year. They made $10.61 last year, and then $14.54 for 2026. So this could be a buying opportunity in United. Let me just see real quick what the other guys are doing. Are they all down this much? I'm assuming. I'm just getting the other airlines that I just talked about up on my chart. Okay. Yeah, they're all mostly down. So American is down about the same, 17%, and it's bouncing similarly to United. Both we're in a bear market now, down about 17. Alaska, not as bad, but it's still down almost 12% in the last month. And it's trying to recover a little bit here. So, yeah, take a look at the airlines. Normally, I'm not a big fan. I don't own any. I don't own any in the value investor portfolio either. I have tried to go in, I think, off and on over the years. But I think I used to own Hawaiian, actually, because I did like those Hawaii routes. But right now we don't own anything, but maybe I'm going to take a look myself and see what else is going on with some of these airlines. So that's United Airline, ticker UAL. Okay, let's switch over to financials. Now, this is a little controversial one. And we've talked about it in the past. And in fact, I discovered it here on this podcast when I did one of the screens last year. And it's Mr. Cooper Group, ticker COOP. Always has the weird name, Mr. Cooper Group. What is that about? But it is in mortgages. And it recently closed on a big acquisition when it got the Flagstar mortgage business, which was one of the bigger mortgage companies. So this is a big mortgage company. And I know you're asking, why would we want to be in this if, housing might tank or if the economy goes into a recession, fewer people are going to buy homes because more people will be laid off or just waiting on the sidelines because it's a recession and they're nervous. Why would I want to own a mortgage company under those circumstances? Well, because the 10-year has come down and they don't just do new origination mortgages, they do refinancing. And while the rates were above 7, which has been true for the last numerous months, but it's ranged in the 6s and the 7s and almost 8%, I think, since 2022 when the Fed started, dramatically raising the rates. Who was refinancing? Not many people. But now that the mortgage rates, because the 10-year has declined, have come down into like the mid 6s, I think now. Suddenly, we're seeing a lot of people who maybe had a 7.25 mortgage rate. Well, if you can go from a 7.25 down to a 6.5, you might do that. You might go into that. So last week on the mortgage refinancing, we saw the biggest surge since 2021, I think it was. Numerous years, the biggest surge. So a lot of homeowners are just kind of sitting there waiting on the sidelines, waiting for these rates to go down. And if they go down further this year, even in an economic slowdown, there is still plenty of people who will keep their jobs and who will already be in the house and will want to get that lower mortgage rate and will refinance. So that's a big part of the business. And that's why it's a Zacks number 2, even after this last earnings report, which is the buy, because while earnings were surging last year, up 42%, they're still expected to be up 27% this year and another 18% for 2026. The stock still remains cheap, and it was when I covered it last year. That's why I was like, this seems like an interesting story as those mortgage rates come down, because it was still doing well even with the high mortgage rates. But the forward P is now 8.2. That PEG ratio is just 0.3 because of the strong earnings growth that's still expected. And we already have the low PE. But has the stock pulled back like United Airlines? No, it actually hasn't. So it's kind of holding at its all-time highs. And it's actually up about 5% in the last month. It's not getting, as big a boost as it would have if we didn't have a total market sell-off, but it is holding right around those highs. So this is the type of stock where you're like, you look at the chart, you look at the 5-year highs, you look and see that the earnings estimates are all higher, and you get scared to buy in here. The actual price per share is now around, well, it's at 108 when I'm recording this, 108 to 110. Its 52-week high is at 114. So it has pulled a few dollars off those highs. But you look at it and you're like, how much more can be in the tank? And or, if the overall economy is having these troubles, won't Mr. Cooper Group? Now, I did think this would pull back more in this overall sell-off because the baby is being thrown out with the bathwater. But apparently, a lot of investors in Mr. Cooper Group actually know the underlying story here. And as those 10-year treasuries are declining, this stock should do better, not worse. So I still love it. I still own it in the value investor, obviously, and I still own it in my own personal portfolio. I did buy it after the value investor portfolio bought it because it's just cheap. It's got the double-digit earnings growth, and this is a great value growth combination, which we don't see very often. So that's Mr. Cooper Group, COOP. And then I wanted to cover a healthcare stock. And this is one I haven't taken a close look at, but I went in to look at the charts for the podcast just to kind of see what was going on with it before I chose it as one of the 3 stocks. And I was looking at a chart that I really like as a value investor. So this company is Amicus Therapeutics, ticker F as in Frank, O, L as in Larry, D, FOLD. And when you look at the actual just, stock chart, doesn't look that good. It's traded in between $6 and $14 for 4 years. And now we're going on the 5th year. So this is a classic type of value chart where the stock can go nowhere for many years, but it does get cheap. When it will finally bust out of there, we don't know. You could have bought this a couple of years ago thinking, oh, it's been going sideways for a couple of years. It's going to bust out at some point, and then it hasn't. But right now, the stock is off of that trading range. It's not near $14. It's trading around $9 here. So this could be a good entry point. Even if it continues to stay in this narrow trading range, it is on the lower end of the trading range, near its 52-week lows, actually, which I believe it just hit during the sell-off, or it got close to it. So over the last month, the shares are down 7.5%. So not quite as bad. It never went into the 20% range, and not even the 10% range. So we're not even at a correction yet with Amicus, but still liking it here because of what is going on with the fundamentals. So again, just looking at when you look at the price and consensus chart, the consensus is much higher than where the price is. This is a type of chart I like as a value investor. That's where we get the cheapness because the street is really just ignoring it. So in 2024, earnings were flat. And that's one of the issues I think that they didn't, the street did not like. But looking at 2025, earnings expected to be up 79%, 2026, 65%. Amicus Therapeutics is a biotech. So something good must be going on. So they say we are a biotech company at the forefront of advanced therapies to treat a range of devastating rare diseases. But they do have a PE So they are actually having earnings, and that is somewhat rare for a biotech as well. They have a forward P of 21 right now, so that's not that cheap. But the PEG ratio is just at 0.5 because we have that extreme earnings growth expected. And taking a look at the detailed estimates now, revenue expected to be up 20% this year to 635 million. So they are a smaller cap company. 2026, another 19% growth. And they're expected to make 43 cents this year. And they only made 24 cents last year. So that's where we're getting the 79% earnings growth. And then for 2026, expect to make 71 cents. Now, the estimates are kind of all over the place. The last 60 days for 2025, one is up, two are down. So we are Zacks number 2 rank here, even though two of them are down. But over the last 30 days, we only have one estimate that's raised. Nobody's cutting in 30 days. And that's probably taking precedence here. And that's why we're getting the number 2 by rank. So I'm liking all of that. It is down a bit from the 90 days ago on 2025 and 2026. So clearly the analysts got a little too bullish before this last earnings report, which they missed by a penny only, but they did miss by a penny, and they had to adjust their earnings. So it was expected to be 48 cents for this year, and now it's down to 43 cents, as I mentioned. So they've adjusted 5 cents. This still looks good on the chart because the gain is so big for this year and next year. They're expected to continue along this path. So that's where we get the low peg. So we have both value and growth. The stock market, again, is rejecting it and has been for 4 years. But these are the type of companies where if they can actually do that earnings growth, eventually the street will buy in and they will discover it. But right now, they aren't. So you're going to have patience on this one. And you're going to have to do your own research and figure out what is going on with, what is happening there in the actual underlying earnings. We do go to the healthcare conferences. I'm kind of looking to see what's happening on their calendars. So there will be announcements going on outside of earnings. I'm kind of just looking to see what is driving it. So they are seeing, again, I like to have biotechs that have, actual drugs coming to market or products coming to market in some form. And they had total revenue growth in fiscal 2024 full year of 33%. And that's pretty strong. So one of their drugs, it looks like, is Galafold. And that saw revenue growth up 19% in the year of 2024. So things are going on there, and you'd have to have some underlying drugs that are doing well to get this kind of earnings growth. So take a look at Amicus Therapeutics. It's cheap now. Fold is the ticker, FOLD. Shares are down 7.8% in the last month. This is making it cheaper than it has been. It's not cheap on the PE basis, but on the PEG, it certainly is. And it's got the right Zacks rank. And that strong earnings growth is tremendous. So I like discovering some of these types of stocks. Market is not rejecting Mr. Cooper Group here, so it's trading near its highs, but they have fallen out of love with the airline stocks. So take a look at those. And then some of these others that are just cheap on the growth side of things here. So let me recap the stocks. Again, we had United Airlines, UAL. We had Mr. Cooper Group, COOP. We had Amicus at Fold, F as in Frank, O, L as in Larry, D as in David, FOLD. And then we did talk about Alaska ALK and American AAL. So check out all of them. And I'll be running more of these screens every week here as we move along, especially if this sell-off continues. Maybe it's time to look at some classic value stocks soon and see what's in that group. We used to get the home builders in there all the time, but again, without those Zacks Rank, we're not going to get those. What will be in its place? I don't know. Maybe I'll run that screen next week. But as always, on big sell-offs, there's always going to be a lot of value. Oh, and on another note, I know some of you are looking at those energy stocks. They have been crushed down here in 2025 as WTI is moving closer to 65. And if it goes to 60, those energy stocks, especially in the exploration side, the E&Ps as we call them, those will be crushed down more. I'm on the sidelines, adding to any positions or buying anything new on energy. So I really should do a podcast on the energy stocks as well, because they look cheap here, but they are very much a trap. So be sure to subscribe and tune in. Definitely get us on our YouTube channel. It's the separate podcast channel. Put in Zacks Podcast and you can find it on YouTube. Just subscribe over there and then you'll get ETF Spotlight and all of our other podcasts, including Earnings and John Blank's Global Outlooks. So you want to get them all there. If you want the Market Edge podcast, my other podcast, you have to get that on the normal Zacks. We always call it the normal one. The normal Zacks YouTube channel. That's the video channel. And that's just Zacks Investment Research. It's a separate channel, and you can just subscribe over there to get all of our other videos plus the Market Edge. But be sure to get us somewhere. The audio is always available on Apple. We're on Spotify. We're on Amazon Music and SoundCloud. Just about anywhere you can get podcasts, you can find the audios and all of the Value Investor podcasts. So be sure to subscribe somewhere, as I said, and I'll be back next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.